Hello, I am Reese Bailey, representing Aesthetics by P. Brown. Part 2 of our personal financial planning series is entitled Using Financial Statements. We should use financial statements in our personal financial planning to define current financial positions that we hold. You can track changes in your financial positions over time using these statements. So you will want to create a file folder, and I file my financial statements on a monthly basis, and at the end of the year it's very useful for completing your income taxes and also just managing your money and updating and changing your budget. You can also monitor progress towards achieving the goals that you set in financial planning by those statements. We don't want to guess because, as I said in the previous segment, if you don't look at that statement and see if you had late charges or service fees or some sort of penalties, just a small amount of money, like $1 or less, will throw your budget off and cost you to pay additional fees because that wasn't considered. So you want to use those financial statements to reconcile your budget. And you can reformulate your plans as situations change. And there's big events that occurs in everyone's lives, like marriage and children coming into the world, and divorce and moving and changing jobs and those sorts of things. And you can just use your financial statements to reconcile your budget and to reformulate your plans for maintaining a healthy financial position. We want to use those financial plan statements and the information on those statements to create a balance sheet. The definition for a balance sheet is a statement of your financial position at any one point in time. The balance sheet is the summation of your assets, and those assets will equal your liability minus your equity to determine your net worth. So if you take everything that you own, those are your assets, your car, your house, your anything that you own, even your savings and such. And some of those assets may have a debt attached to it. So you want to take the total value of those assets, subtract the debt portion or the liability portion to come up with your net worth. Here's another depiction of a balance sheet. You can put the assets and just list those at the fair market value on the left side, and then on the right side you can list all your liabilities. That is, the liabilities is the payoff amount, what you owe, what the balance is that you owe on any debt that you may have, and it comes up with your net worth, and that defines your position financially. Another depiction with some specific examples of assets that be checking accounts, cars, savings accounts as well, investments, jewelry, furniture, those types of items. All of your assets, but you may have a debt attached to those assets. On the right side of this chart, you would subtract those debts. How much do you owe on your mortgage? If you have a $100,000 house and you have $20,000 in equity, then that 20,000 is going to go as a part of your net worth, and the other 70,000 will be a liability. So you want to work that through with the car, with the balance on your credit card, student loans, anything like that. You should know what your net worth is right now in life, and that helps you understand your position, and will help you achieve your goals with personal financial management. Here's another explanation just to make sure about net worth and the equity that you own in some of those assets. So you get the total assets minus the total liability to equal that net worth, just as I pointed out earlier. If you have any questions, please let me know, and have a great day. Thank you.